Okay, so you want to own a private prison, you put up a building full of cells, sign a contract with a government that has more people than beds, and collect a fixed payment for every person who sleeps in your building every night. On paper, it looks like the cleanest customer relationship in American business. Your client is a government, and governments pay their invoices. Demand doesn't soften in a recession because nobody postpones a 15-year sentence because the economy slowed down. No competitor opens across the street to undercut you. No advertising, no seasonality. Just a building, a fence, a roster, and a payment that lands every month like clockwork. A utility with razor wire on top. The problem is everything that sits between the contract you sign and the building you're left holding. That payment isn't the business. The building isn't the asset. And the thing that actually kills companies in this industry has almost nothing to do with the people locked inside them. Set the moral argument aside for a moment. It's a real argument, and it deserves better than being smuggled into a spreadsheet. This is about the ledger. What it costs, where the money comes from, and why an industry that looks recession-proof lives one memo away from collapse. Let's start with what you think you're buying. You think you're buying a building. You're not. You're buying a contract with an expiration date and a building that only makes sense as long as that contract exists. Start with the physical thing, because the physical thing is brutally expensive. A medium security correctional facility costs somewhere in the range of $100,000 to $150,000 per bed to build in today's dollars, and high security work runs well past that. So, a 1,000-bed facility is a $100 million to $150 million project before you've admitted a single person. That number shocks people because $130,000 a bed sounds like a decent apartment, and an apartment comes with a kitchen and a parking space, but you're not building bedrooms. You're building a machine designed around the assumption that everyone inside it wants out. That means a secure perimeter with double fencing, detection systems, and camera coverage across the whole line. It means a control room that can lock and unlock every door remotely, with backup power that holds those doors when the grid fails. It means sally ports, so nobody moves between zones without being sealed in a box first. It means fixtures engineered so they can't be broken into a weapon or used as an anchor point, which is why a toilet in a cell can cost several $1,000s, while the same fixture at a hardware store costs $200. It means a medical wing, because you're legally responsible for the health of everyone inside. It means a kitchen producing 3,000 meals a day, forever, with knives counted in and counted out. None of that generates revenue. All of it is required. Now, the financing question, which is where the first trap opens. A bank will lend against an apartment building at 70 or 80% of value without much drama, because if you default, the bank takes the building and sells it to one of 10,000 buyers who want an apartment building. A prison has one use and roughly one category of buyer, and that buyer is the same government that just decided it doesn't need your beds. The collateral is nearly worthless in the exact scenario where the lender would need to seize it. So the industry solved that two ways. Large operators built on their own balance sheets with corporate debt, meaning the loan is secured by the whole company rather than the one facility. Smaller projects got built through local government conduits, where a county issues tax-exempt bonds and the per diem payments service those bonds. The county takes on risk it usually doesn't fully understand, in exchange for 200 jobs in a town that lost its factory. That's the structure that built this industry. Not investors chasing incarceration, rural counties chasing employment. Here's where it gets interesting, because in the 1980s and 1990s, the industry did something almost no other real estate business dares to do. It built on speculation. Corrections. Corporation of America was founded in Nashville in 1983 and opened its first facility in Houston in 1984, holding immigration detainees. The GEO Group started the same year as the corrections arm of Wackenhut out of Florida. The bet both companies made was simple and, for about 25 years, correct. The American prison population was going up and was not going to stop. The numbers backed them. The United States held roughly 500,000 people in state and federal prisons in 1980. By 2009, that figure was above 1.6 million. Every year, more people, and every year, states discovering they were tens of thousands of beds short with no appetite to spend $1 billion on construction. So, you build the beds first and sell them afterward. You put a 1,500-bed facility in a county that gave you the land and a tax abatement, you keep it empty, and you wait. States with overcrowding emergencies call you because a court just ordered them to reduce density, and you're the only person alive with 1,500 empty beds ready this quarter. You charge a premium because you're not competing on price. You're competing on the calendar. Then, around 2009, the line stopped going up. Sentencing reform, declining crime, budget pressure, and a real political shift meant the prison population started falling. And a speculative building strategy in a shrinking market doesn't produce a discount. It produces empty concrete you still have to insure. Now let's talk about how the money actually arrives, because this is where the whole business is decided. Your unit of revenue is not the prisoner. It's the bed day. One person, one night, one payment. Everything gets priced in that unit, and every conversation about profitability is really a conversation about how many bed days you sold this quarter and what you got for each one. State contracts typically pay $60 to $100 per person per day, depending on the state, the security level, and how much medical care is bundled in. Federal work pays more, sometimes considerably more. Let's build a facility and run the math. Say you own a 1,000-bed medium security facility that cost $120 million. Your contract pays $75 per bed day. Full, that facility bills $75 times 1,000 times 365, which is about $27.4 million a year. At 90% occupancy, roughly $24.6 million. $24 million a year against a $120 million building sounds excellent, right up until you look at what it costs to run. Labor is 60 to 70% of your operating budget, and there is no version of this business where that changes. A 1,000-bed facility needs somewhere around 250 to 320 employees, once you count correctional officers across 3 shifts, plus supervisors, case managers, medical staff, kitchen, maintenance, and administration. Load each of those positions at $45,000 a year, including benefits and payroll taxes, and you're at $12 million to $14 million before anything else happens. Then medical. This is the line that has bankrupted operators who underbid contracts. You are constitutionally obligated to provide health care to everyone in your custody, and this population has worse health than the general public, less prior access to care, higher rates of chronic illness, and an aging cohort serving long sentences. Budget $12 to $20 per person per day, and you're at $4.5 million to $7 million a year on a 1,000-bed count. One inmate needing dialysis or a cancer protocol can move that by 6 figures alone, and the contract doesn't move with it. Food runs $3 to $5 per person per day, so call it $1.3 million. Utilities on a building that runs lights, HVAC, laundry, and hot water continuously. Another $1 million or $2 million. Liability insurance, which is not cheap in a business where every incident is a potential lawsuit. Maintenance on a structure used harder than any commercial building in the country. Transport, because you're moving people to court and to hospitals with 2 officers per trip. Add it up honestly, and a 1,000-bed facility, billing $24.6 million, spends $19 million to $21 million to operate. You're left with $3 to $5 million a year against a $120 million asset carrying debt. So far, this sounds like a machine that prints money. It isn't. On those numbers, it's a mediocre real estate deal with enormous headline risk. And it raises the obvious question. If the margin is that thin, how did you win the contract at all when the state's own Department of Corrections was already doing this work? The pitch of this industry is that it delivers the same service for less. Take that claim apart, and there are only a handful of places the savings can physically come from, and every one of them is a cost you've moved rather than eliminated. The first is wages and benefits. A state correctional officer is usually a public employee with a pension, civil service protection, and a union contract. A private one typically isn't. Starting pay in private facilities has historically run several dollars an hour below the state equivalent, with a defined contribution plan instead of a pension. On a 280-person payroll, a $4 an hour gap is roughly $2.3 million a year, and the pension difference can be worth as much again. That single line is most of the savings this industry has ever claimed. The second is the population you agree to take. Contracts are frequently written to exclude the expensive people. Maximum security classifications, inmates with serious mental health diagnoses, inmates requiring intensive medical care, and inmates near the end of long sentences with accumulated health problems often stay in state custody. You're bidding on the low acuity half of the population and being compared per bed day against a system carrying the whole distribution. The comparison flatters you before you've done anything. The third is headcount on the floor. Fewer officers per housing unit, more reliance on cameras and controlled movement, thinner supervisory layers. That's where the lawsuits come from. None of this is hidden. It's in the contracts and in decades of state audits. But understand what it means for you as an owner. Your margin is not a technology advantage or a scale advantage. It's a labor cost spread and a favorable patient mix. Both can be legislated or negotiated away, and neither improves with time, which is why the actual business is hiding in one clause. Here's the trap. Almost nobody sees coming, and it works in the operator's favor. A large share of these contracts contain an occupancy guarantee. The government agrees to pay for a minimum number of beds, whether or not those beds are occupied. A 2013 review of dozens of private corrections contracts by the group In the Public Interest found that around 2/3 of them contained bed guarantees, most commonly set at 90%, with some contracts, notably in Arizona, written at 100%. Read that again because it inverts everything. In a normal business, empty inventory is your loss. Here, empty inventory is billed to the customer, and the reason that clause is so valuable is buried in the cost structure. Your staffing is set by the building, not by the headcount. A housing unit with 128 beds needs the same officer on the floor at 96 occupants as it does at 128. The kitchen runs, the perimeter is staffed, the lights are on, your costs are close to fixed across a very wide range of occupancy, so work the marginal math. If your guarantee is 900 beds and you're holding 900 people, you're covering your fixed base and clearing a few million. Every person above 900 arrives with a variable cost of around $18 a day in food and incremental medical and generates $75 a day in revenue. That's $57 a day of nearly pure margin, $20,000 a year per additional body on a cost base that barely moves. Fill that same building to 1,000 and your profit doesn't rise by 10%. It can rise by 50%, and below the guarantee, you're insulated. The state sends you 780 people and still pays you for 900. You are not being paid to house people. You are being paid to stay ready to house people and then paid again for everyone who actually shows up. That clause has a mirror image, though, and the mirror is where operators bleed. The same contract that guarantees your revenue also specifies your staffing. Post charts, minimum coverage per shift, required positions filled, and it attaches money to failure. Miss a mandatory post and the state deducts the cost of that post from your invoice, often with a penalty multiplier on top. Fail an audit on training hours, medical response times, or use of force documentation, and there are deductions for those too. States have withheld millions from operators over vacancy rates and audit findings, and a few contracts have been terminated over them outright. That turns your staffing problem into a revenue problem, and staffing is the hardest thing in this business. Officer turnover in private facilities has run above 40% a year in normal conditions and past 50% in tight labor markets. You're asking someone to work a 12-hour night shift in a locked concrete building, absorb the psychological load of that job, and accept $20 an hour when the distribution center off the interstate pays $19 for a shift when nobody threatens them. Now, watch the loop close. You can't fill the posts, so you run mandatory overtime on the officers you have, and time and a half on a $12 million payroll burns through the labor spread you bid the contract on. Exhausted, understaffed shifts produce more incidents, and incidents produce audit findings, litigation, and deductions. The one lever that would fix all of it, $3 more an hour, costs $1.7 million a year on 280 employees, which is a third to a half of the entire profit on the facility. That's the actual squeeze in this business. Your revenue is fixed by a contract signed years ago. Your single largest cost is set by a labor market that doesn't care what you signed. That's the real per diem business. Now here's the other side of the ledger, because the per diem was never the whole revenue picture either. A facility generates money from the people inside it and from the families outside it. Commissary is a store with a captive market and no competitor within 100 miles, selling instant coffee, ramen, and hygiene products at retail margins to people earning cents an hour. Money transfer services charge families a fee every time they put funds on an account. Video visitation, which in many facilities has replaced in-person visits, charges by the session. Phone calls were the most lucrative of these for decades. Rates in some facilities ran over $1 a minute once connection fees were counted, and operators paid site commissions back to the facility, which meant the institution had a direct financial interest in the price of a phone call being high. A 15-minute conversation between a father and his child could cost more than a 15-minute international call from a landline in the same town. That stream is being regulated out of existence. The FCC capped interstate rates in the 2010s. Congress passed the Martha Wright Reed Act in early 2023 to close the loophole exempting in-state calls, and the FCC issued rules in 2024 pushing rates towards single-digit cents per minute and restricting site commissions. A line that once threw off hundreds of millions across the industry is being compressed toward cost, which brings up something you need to understand about every revenue line in this sector. None of them are protected by a market position. All of them exist because a government allowed them to exist, and any of them can be legislated away in a single session. Now, the reveal that changes how you read the entire industry. Look at who's actually paying. The two largest operators do not primarily make their money from state prisons anymore. Roughly half their revenue comes from federal agencies, and the dominant piece of that is immigration detention and federal marshals' custody. That's the growth engine. State prison populations declined. Immigration detention capacity did not follow the same curve, because it's driven by executive policy rather than crime rates or sentencing law. Those contracts also tend to be written on better terms for the operator. Many use fixed monthly minimums rather than pure per diem, meaning you're paid a set amount for the facility regardless of population, with a lower incremental rate above a threshold. Effective daily rates in that segment can run well past state prison rates once the fixed minimum is spread across an actual population. So, the naive picture, where you own a prison holding people serving criminal sentences for a state, describes a shrinking minority of the business. The economics you're actually buying are a federal contract, priced off a policy decision, renewed at the discretion of an agency whose leadership changes with an election. This is where the first genuine trap opens. On August 18, 2016, a Deputy Attorney General named Sally Yates issued a memo directing the Bureau of Prisons to reduce and ultimately end its use of privately operated facilities. It was one document. It didn't touch state contracts. It didn't touch immigration detention, which was and is the larger business. Both major operators lost roughly a third to a half of their market value in a single trading day. In February 2017, a new administration rescinded the memo and the stocks roughly doubled. In January 2021, an executive order directed the Justice Department not to renew private contracts, and the Bureau of Prisons work wound down over the following 2 years while the immigration detention work continued. Nothing operational changed on any of those days. No facility burned down. No population moved. The revenue for the next quarter was already contracted. What changed was a piece of paper describing what a federal department intended to do, and it moved billions of dollars of enterprise value in an afternoon. That is the actual risk profile you're buying. You're not exposed to crime rates. You're not exposed to consumer demand or interest rates in the way normal real estate is. You're exposed to the outcome of elections and the discretion of appointees on an asset with a 30-year useful life and a contract term of 3 to 5 years, and then the financing trap closed on top of it. Between 2019 and 2021, essentially every major American bank that had lent to this sector announced it would stop. JP Morgan, Wells Fargo, Bank of America, SunTrust, PNC, Barclays. Not because the loans were performing badly, they were performing fine. The banks exited on reputational grounds under pressure from activists and institutional clients. Consider what that does to a capital-intensive business. Both major operators had converted to real estate investment trusts in 2013, the peak of the financial engineering. A REIT pays essentially no corporate income tax as long as it distributes at least 90% of taxable income to shareholders, and for a company whose assets are buildings under long-term government contracts, that structure was close to perfect. It also made them dependent on capital markets, because a company paying out 90% of its income cannot fund itself from retained earnings. It has to keep borrowing. Take away the lenders, and that structure becomes a trap. Both companies abandoned REIT status in 2021 and returned to being taxable corporations, specifically so they could stop paying out dividends and use their own cash flow to pay down debt. They chose to pay corporate income tax voluntarily, which almost no company ever does, because the alternative was refinancing risk they could not control. That's the sequence that should stay with you. The industry's biggest crisis was never a riot, a lawsuit, or an empty building. It was a group of banks deciding that the client was no longer worth the headline. So how does this business actually die? Not from a shortage of prisoners, from a building with no second customer. When a contract isn't renewed, you don't get a bad year. You get an idle facility. And an idle correctional facility is one of the most useless large assets in the country. You cannot convert it into apartments because the units have no windows that open, no kitchens, and a floor plan built around sightlines from a guard station. You cannot convert it into a warehouse because it's a maze of small concrete rooms. You cannot sell it to a competitor because your competitor has the same problem in the same county with the same customer. There are facilities that have sat empty for more than a decade. A 2,000-plus bed facility in Watonga, Oklahoma went idle after its contract ended in 2010. A facility in Appleton, Minnesota went dark the same year and stayed that way while the town that built its economy around it argued about what to do with it. An idle facility is not free to hold. Property taxes, insurance, minimum utilities to keep the building from degrading, a skeleton crew for security and maintenance. Call it $1 to $3 million a year to own a building that generates nothing, on top of the debt still attached to it. Operators carry these at book value and describe them as available capacity, waiting for the political cycle to swing back. Sometimes it does. Sometimes the building gets sold back to the government at a discount, and sometimes it just sits. This is why the smart money in this industry stopped thinking of itself as being in the prison business at all. Look at where the highest quality revenue actually sits, and it's in two places that don't look like prisons. The first is leasing. There's a meaningful difference between a facility you own and operate and a facility you own and lease to a government that staffs it with its own employees. In the first case, you carry the payroll, the turnover, the medical liability, and the lawsuits. In the second, you collect rent. Margins on owned and leased facilities run far above owned and operated ones because you've handed the hardest and most expensive part of the business back to the state and kept the part that behaves like real estate. The second is monitoring, and this is the reveal that reorganizes the whole picture. In 2011, GEO acquired a company called BI Incorporated for around $415 million. BI runs electronic monitoring, ankle bracelets, check-in technology, and case management, including the federal program that supervises immigration cases in the community rather than in detention. Compare the economics honestly. A detention bed requires a $100 million building, 300 employees, a medical department, and a per diem of $75 to $150. An ankle monitor requires a device costing a few $100s, a call center, and a software platform, and it bills a few dollars a day. The daily revenue is a fraction. The margin is not, because there is no perimeter, no officer on a night shift, no kitchen, and no constitutional obligation to provide healthcare to a person living at home, and it scales without capital. Adding 10,000 people to a monitoring program is a procurement and a software deployment. Adding 10,000 beds is $1 billion and 4 years. The most profitable person in this industry is the one who is not in a building at all. That's where the business has been quietly moving for 15 years. Community supervision, re-entry centers, day reporting, transitional housing, monitoring technology, the same companies that sold themselves for 3 decades as the answer to overcrowding now sell themselves as the answer to incarceration. And the second product has better margins than the first ever did, which tells you what these companies always were. They were never in the business of holding people. They were in the business of absorbing a government's capacity problem for a fee, and the form that fee took was always negotiable. When the problem was overcrowding, the product was beds. When the problem became the cost of beds, the product became supervision. The country spends its energy arguing about what happens inside the walls, and that argument matters more than anything in this script. But the people who own the walls are not in that argument at all. They're looking at 3 numbers: the per diem, the guaranteed minimum, and the date on the last page. The cells were never the business. The renewal is.